points. We have Girish Pai, Head Research Institutional Equities at Nirmal Bank Institutional Equities, joining us from Mumbai. Girish, thanks so much for being with us at NDTV Profit. The markets have nosedived now. Nifty has seen selling at higher levels. Do you think the markets could now see some correction? Because what are the triggers going ahead? We don't know what's going to happen to growth post demonetization. Expectation is that it will come back, but then you have the GST that will be disruptive again. Rate cuts may again, whether they happen or not, it's again up in the air. So do you think because of increased uncertainties, the markets could correct from here?
Short-term movements of the market are very difficult to predict, but if I look at a few factors which determine market direction in the shorter and the medium term, I think the demonetization issue, people had feared the worst as far as the December quarter numbers are concerned. So I think the fears have not played out, except for a very few pockets of the market. I think the earnings have been better than expected, be it financials, be it auto in certain parts. So I would think that earnings fears as far as FY 17 are concerned are probably getting allayed. Maybe we could probably see some weakness come through in Q4, because I think the growth in Q3 could have been because of bringing forward of purchases by people who wanted to use up cash, or there could have been some stuffing of the supply chain, so to speak, by certain companies. But I think broadly, fears regarding washout on the earnings front for second half of FY 17 have kind of been pushed back, and that is kind of getting reflected in the way the market is moved. So the earnings picture looks fairly better now than it did maybe a month and a half back. And I think going into FY 18, I think things should look better. Yes, there are a couple of issues that FY 18 would potentially present. One is implementation of GST, and there could be some dislocation connected with that. There could be some dislocation connected with implementation of Real Estate Regulatory Act. So one needs to watch out for that, but I think probably we're making too much of some of these dislocation factors, because I think we've kind of got our call on demonetization wrong, at least in terms of the impact, negative impact that's going to be there on the market and earnings. So I would definitely watch out for those events, but I doubt that they're going to derail earnings in a very significant way. If I look out into FY 18, consensus earnings expectations on index are probably in the late teens to early 20s. Those seem slightly inflated. They may probably come off, maybe not come off as much as I thought they would, a month and a half, two back. So to that extent, I think earnings picture looks definitely better now. Obviously, the picture on flows have been fairly good, at least on the domestic side. I think it seems to be strengthening as days pass by. There's more money coming in from the domestic market because of the fact that the alternative asset classes are not looking too great. Be it from a real estate standpoint, or be it from a fixed deposit standpoint, or now that we probably see a reversal in the interest rate cycle, maybe even money moving away from debt funds into equity. So I would think that from a flow standpoint, at least in the domestic side, things look good. The global flows look a slightly tricky element to call right now. One really doesn't know how things are going to pan out globally, but as of now, looks like even they're kind of helping out, or they're more of a tailwind rather than a headwind, which was the case maybe a few months back. So the picture looks fairly good, except for valuations. I think valuations are probably tad higher than what they were a month and a half back, and to that extent there will be some bit of discomfort, especially in, I would say, quality mid caps. I think there's been a lot of money flowing in, and valuations look a little stretched. If one looks at, say, September 2018 numbers, which is what we've been looking at, you need to push back the earnings number. If you look at FY 19, probably there's some bit more upside. So broadly, that's the picture. We continue to like the market. We were initially thinking that probably the upside in the market is going to come through towards a 9,000 level by end of 2017. it's kind of got brought forward because of the fact that the demonetization hit has not really been as bad as what we anticipated.
All right. So if you expect growth to come back, and what do you think will be the sectors that will see this growth come back in the fastest possible fashion? You spoke about bunching of some demand, a preponement of some demand. Would you then avoid these sectors? How would you pick from here on?
Yeah, I mean, that's a guess in one sense. I mean, if you look at some of the numbers in certain sectors, it looks like, there's been some kind of bunching of demand because probably people wanted to, use up the cash that they had. So I wouldn't, look at the shorter term, issues connected with the bunching of demand and stuff like that. I would rather look at FY18 or FY19 valuation and what is the medium to longer term growth prospects of sectors, and based on that I would kind of put my money there. I think our philosophy or our investment thought process has not changed much. Our portfolio construction broadly remains the same. We like financials, especially those which are retail facing. So we like the banks which have got a large retail franchise. I think these are book value compounders, or earnings compounders. Valuations are rich, I do admit, but I think those valuations can potentially sustain, and as long as book value compounds and at intervals of 3 to 4 years you have infusion of capital at the same price to book multiple, a 3 or a 4x price to book multiple, that kind of adds to the book value. So you have a 15-20% CAGR in terms of book value, and then on top of it you have a sweetener coming in every 3-4 years. I think that gives you a fairly decent return of the core part of your portfolio, so to speak. Then you have to dip into some of the other financials, which will be select NBFCs, where we've been kind of bullish on, say, the gold finance players. We've been focused more on some of the MFIs. We have been a little wary of real estate based MFIs. We think that could potentially face some bit of pressure going forward, because both because of demonetization, because they focus on black money. We think that transactions in this space is going to be slightly slower, and probably there could be some price correction which could lead to some asset quality issues going forward. So we would kind of try to avoid MFIs which either have an MSME portfolio which has property as collateral, or even I would say to an extent the housing finance companies, which to some extent could be potentially impacted by the fact that you will not see the house price inflation as one has seen in the past. So we kind of looking at the gold finance companies, which we think while there's been a fairly sharp bounce back post the sharp correction one saw post demonetization, we think that valuations still look fairly interesting. I think some of these stocks are going at 2 times FY18 adjusted book, and I think on FY19 they're probably going at 1.7 times book. So if you look at their peers in the market, we think that there is a fair bit of upside there from a valuation multiple expansion standpoint. And I think the fact that they have a fairly good collateral which can be liquidated fairly short notice makes me feel that this is an area one should focus on. And I think it's a very underpenetrated area. If you look at the gold reserves, the gold, the jewelry, how much is the stash that's there in the Indian economy? That's anywhere between 22,000 to 25,000 tons. A player like Muthoot, which is the largest formal player in the gold loan sector, that's just got about 165 tons, and a player like 165 170 tons, whereas a player like Manappuram is only handling about 65-70 tons. So these are very small players. There's a huge amount of runway for these guys to to grow, and there is a very large informal part of this business which will probably become more formal as we move into an era of demonetization, more less cash transactions, and a GST regime and stuff like that. So I would think that these players are going to benefit from a market share shift, and also I think organically I think there's a lot of room for these companies to grow. So that's an area that we've liked in the past. Yes, they've also rejigged their business model in one sense, in the sense that they've all kind of tried to reduce their exposure to gold price declines by changing the tenor of their loans. So now they're working on a 3-month or a 6-month tenor loan compared to a 1-year tenor loan, and say a few years back. So that's reduced the risk connected with gold price decline. So that's a space that we like. So as I said, retail oriented banks, some of select NBFCs, I would say select auto, I would say select cement stocks. Cement as a sector, we were bullish probably about 3-4 months back. But we think now that, because of demonetization, because of RERA, we would probably see probably negative growth this year in FY17, and probably a very low single digit, maybe 3-4% kind of growth next year, which should not be too great from an EBITDA margin standpoint and price increase standpoint. So there we like a few stocks which are more focused on, say, the white cement business. So as I said, there are pockets and there are certain mid caps we like. We like pharma. There are certain stocks in pharma we like. We like Cipla. We like Dr. Reddy. So that's broadly the kind of way we kind of constructing a portfolio at this point in time.
Right. Can you just be a little specific, Girish? Any names that you could take and explain? You explained some of the NBFCs in great detail. Any other new initiation at Nirmal Bang?
Okay, so on the auto side, I think there's been, I think some of the stocks have done exceedingly well in the last 1.5-2 months. So one stock which we still think there is a lot of upside is a player called VST Tillers. So it's not just a tiller player, it's also a tractor player. I think the revenue mix right now is 35-65. 65 is tiller and 35 is tractor. We think that mix is may, if not reverse, but will probably substantially be more in favor of tractors a few years down the road, because that is the focus of the company right now. So it's currently addressing the tractor market, which is sub 30 HP, which forms, in my analyst opinion, just 10% of the tractor market. So this company is going to address the rest of the tractor market. They're going to start selling more than 30 HP kind of tractors down the road, and I think they've already started doing that. So I think we think that while in the below 30 HP tractor they've kind of got a 20% market share, we think that I wouldn't say they're going to potentially replicate that, but I think over a period of time that piece is going to start growing quite fast. And we think that is a stock to look at with the focus on agriculture that the government has got, with the focus on farm mechanization. So we think that this is a player which can compound earnings at a fairly sizable clip. It's got very good EBITDA margins. I think closer to high teens kind of an EBITDA margin, which is not a common number across the auto space, and it's got very good return ratios. And I think it is coming at, if I'm not mistaken, in the mid-teens to low teens kind of on an FY19 basis. So we think this is a play which can give you a fairly decent compounding in terms of earnings. It's going at capacity. Currently, its capacity utilization is just about, I think, 40-45%. So it's already put in place most of the capex that's required for growth over the next 3-4 years. So there's no incremental capex that's required right now. So most of the growth, be it on the tractor side or on the tiller side, can be done with the existing fixed assets that they've got. So we like that stock. We had liked Maruti and we had liked Hero, but I think the stocks have all run up quite a bit and they're closer to our price targets as we speak. In the pharma space, we like Cipla. Cipla has been one of our top large cap bets. So Cipla is, I would think it's a play where we think that the fact that it's got a much lower exposure to the US geography. Apparently, just got about 15% exposure to the US geography compared to maybe a 40, 45, 50% exposure that most of the other large Indian companies have. In our view, is a good thing. Yes, there are currently the Indian companies are facing their own set of issues in terms of FDA and all potential border tax put by the Trump regime. But we think that that's a growth area for potential growth area for Cipla, with a lot of ANDA filings that have been done by Cipla. The other aspect is that we think margins can improve from here. They somewhere in the region of 18%. We think that can go to maybe a 22% in 3 years' time. We think that a lot of the investments have been done by the company upfront, especially in terms of employee. In terms of the employees that have come on board. So we think that there could be some operating leverage there. We think that they're going to probably exit some unprofitable geographies that they've been kind of operating in. So that could again be helpful from a margin standpoint. I would say the other thing is that unlike a lot of the other pharma companies where there are lumpy revenues in their base revenues and earnings, this is one company where there aren't too many lumpy elements to its revenues and earnings. So to that extent, we think it deserves a better P multiple than what it has got thus far. So these are the factors which we think are going to drive earnings for this company, and we currently have a price target of closer to 700 right now.
Mr. Girish Pai, thank you so much for taking out time for us. Always good to get a perspective. That was a view coming in from Nirmal Bang and the stocks that they like.